Global share markets powered higher over the June quarter, with resilient corporate earnings and renewed AI enthusiasm driving the rally. The US-Iran peace agreement helped reduce geopolitical uncertainty late in June, although recent flare-ups in July have proved that peace in the Middle East remains elusive. Against this backdrop, international shares rallied strongly, delivering double-digit returns for the quarter. The rally was led by technology stocks, specifically those linked to the AI thematic. Energy was the only negative sector for the quarter, with prices retreating from the highs reached during the peak of the US-Iran conflict in March. Australian shares delivered more modest gains over the quarter, given our market contains less companies exposed to the dominant AI thematic. That said, performance was robust and fairly well spread across sectors, with leadership rotating between information technology, materials, healthcare, and consumer stocks. Australian and global fixed interest markets delivered positive returns. Australian bonds benefited as local yields moved lower, while global bonds also gained despite US yields edging higher later in the quarter. Credit markets remained calm, suggesting confidence in corporate fundamentals, despite lingering uncertainty. In the US, new Federal Reserve Chair Kevin Warsh has begun with a clear message: inflation remains the priority. His first meeting marked a noticeable change in tone, with the Fed removing its bias towards lower rates and putting price stability back at the centre of the policy debate. For now, US shares continue to be supported by strong earnings, healthy margins, solid employment, and resilient spending. The AI investment boom remains a powerful engine of growth across technology, communications, and related sectors. In Australia, the RBA is facing a difficult balancing act. The economy is under pressure from elevated inflation, higher interest rates, weak productivity, and a softer housing market. While the RBA's June pause has encouraged the view that rate increases are finished, inflation risks remain elevated, in our view. Overall, the economic backdrop remains constructive, and we retain a positive outlook for markets, despite pockets of risk and stretched valuations in some markets and sectors. Strong earnings, sensible valuations, and a clear understanding of central bank policy remain important when assessing risks and identifying the most compelling opportunities in today's market.